The move by the Bank of Uganda to reschedule treasury bonds worth more than a trillion shilling, which was due for maturity this month, has raised more questions than answers. Although the central bank action is not common, according to financial market analysts, it is also not out of the reach.
It's done by issuers who normally face some liquidity challenges. The amount of bonds that were maturing at one given time were very large, very lumpy maturities. Now, the implication of that, if such large maturities hit the market, there is likelihood that they will create distortion. It could be a market shock, and then it will interfere with the market interest rate structure.
For the issuer, in this case the government, there is nothing much to lose. But for the investor who has been patient, awaiting to cash in, what's the need for him or her?
Rearranging your portfolio. I have been in a bond that is due to mature, but I'm switching into another bond with different terms, different maturity and settlement profile. As long as my return vis-a-vis the previous holding I had is good and it gives me a good return, it shouldn't be an issue.
Bank of Uganda too has weighed on the issue, which has been an interesting topic of discussion emerging from a story written by the East African newspaper on the subject.
Now, if you are a member of a savings group or an individual investor, but you are not contacted about this move, it means that you are not affected. Now, for those whose investments are maturing on the 21st of January, rest be assured that the government will pay both the principal and the interest. After all, it's a well-known fact the world over that governments always fulfill their obligations.
Clearly, this action is rare, and despite the timing, analysts believe it shouldn't mean much because the investors' return are still guaranteed. Ismail Ladu, NTV Business.